What's up, everyone, and welcome to the School of Personal Finance. In this video, we're going to be talking about basic investment vocabulary. So the goal here is to help you out next time you're at a friend's barbecue and you're stuck in one of those conversations that you don't want to be in, and somebody starts talking to you about how great their portfolio is doing in the stock market. This is going to help you, so at least you can pretend like you kind of understand what they're talking about. Let's do it. So for this first vocab video that I'm doing, I'm going to keep it pretty basic. I'm going to go over some terms that you might hear on TV, or if you're at a party, you might hear people talking about them, and I'm going to arm you with just enough knowledge to make you dangerous, so that you could jump into the conversation and make it seem like you at least know what you're kind of talking about. All right, so the first one are stocks. Now, everybody kind of knows what stocks are, but do they really? So with a stock, it's ownership in a company. And the way that it becomes a stock is somebody decides to start a business. So a quick example would be Bill Gates with Microsoft. He started in his garage as a private company. He grew, he created software that everybody loved. He wanted to be able to raise money to continue to grow. So he decided to sell his company to the public, to have an IPO, an initial public offering, where he sold a large stake of Microsoft to the public in return for money. So he was able to raise money that way. And once that happened, the shares of stock, they were then trading on the NASDAQ, on the stock exchange, where anybody could go and purchase shares of Microsoft stock. Now, when you own stock in the company, you are a shareholder. You own a small little piece of that company, and you get to participate in any growth that that company has. And some companies will offer a dividend. A dividend is a cash payment that they make to the shareholders. So if a company is making a lot of money and they want to pay some of that back to the shareholders, they do that through the form of a dividend. So the next term is a bond. A bond is basically an IOU. It's a way for companies or governments to raise money. So a quick example would be if a company decides that they want to raise money, but they don't want to issue any more stock. What they could do is they could have a bond offering. Tesla has been having a lot of bond offerings to raise money, right? So Elon Musk, he goes to the public and he says, listen, I need to raise $1 billion. I'm going to issue these bonds and I'll pay you 7% interest for you loaning me the money. So if you buy a $1,000 bond, you're basically lending $1,000 to Tesla in return for a 7% interest rate on that loan. And then it has specific terms. So maybe it's a 10-year bond, and you'll get interest payments throughout those 10 years. And then at the end of the 10 years, they will give you your principal back. They give you your $1,000 back. That's all a bond is. All right, the next one is mutual funds. So this is another term that you hear all the time. People are investing in mutual funds. My mutual fund is up 10%. And all a mutual fund really is, it is a portfolio that a manager has put together. So there's a portfolio manager who puts this portfolio together of different types of stocks, bonds, different assets inside of the portfolio. And investors are able to buy units or buy shares of that mutual fund. So a mutual fund is going to have a specific style, like maybe it's a growth mutual fund, or maybe it's, a bond mutual fund. So within the mutual fund, you could have hundreds of different individual securities or investments inside of that fund that the portfolio manager has put together. And when you buy or sell a mutual fund, it doesn't take place during the trading day. It settles at the end of the day, and that's when you can either redeem shares or purchase additional shares. The next one is an ETF, exchange traded fund. So this is a basket of either stocks or bonds that trade on the exchanges. So you could buy a growth ETF fund, for example, and if you want to trade that at 1 o'clock in the afternoon, you can, because they're traded on the exchanges. And this day and age, there is an ETF for everything under the sun. So you could buy a gold ETF, you could buy a real estate ETF, you could buy a large cap value ETF, you could buy ETFs that represent all different sectors of the market, all different types. You could really invest in anything you want. You could buy a technology ETF, internet stocks ETF. They have made ETFs so accessible to any corner of the market that you want to invest in. They've exploded in popularity over the last decade. So you could really invest directly in any kind of index, any type of asset class through an ETF or an exchange traded fund. All right, the next one is index funds. So this is another term that has become so popular. You might hear somebody say, oh, I only invest in index funds, or my portfolio is put together a very low cost index funds. What an index fund is, it could be a mutual fund or an ETF that follows a specific index. So the most popular one is the S&P 500. So the S&P 500, you turn CNBC on, you can see exactly how the S&P 500 is doing. If you buy the S&P 500 index fund, then your fund, it mimics that S&P 500 index. So the S&P 500 has, 500 large cap stocks, and that fund will do exactly how the S&P 500 is doing. And now most index funds are very low cost because there's not a portfolio manager. There's not somebody actively picking and choosing which stocks, which bonds to buy and sell inside of the mutual fund. It is just following the index. So if you buy the Dow Jones Industrial Average Index Fund, then that index fund is going to mirror how the Dow Jones does, which is made up of 30 stocks. If you buy the NASDAQ ETF Index Fund, now we're throwing all the terms together. But in that example, there is an ETF, an exchange traded fund, that mirrors the NASDAQ, which is a stock exchange made up mostly of technology companies. So you could buy that index fund ETF. You turn on CNBC, you see how the NASDAQ's doing, and your performance is going to mirror the performance of the NASDAQ stock exchange. So index funds have become very popular. They're the way that I recommend people invest because they're so low cost, they're easy to understand, and it's very easy to see what your performance is and track your portfolio. You're not relying on a fund manager to pick and choose winners or losers, and you're not paying him to do so. The next term is high yield. So like you might hear somebody say, oh, I have a high yield savings account at the bank. And what that means is basically the interest rate, that it pays a high interest rate. Now, there's no such thing as a high yield savings account these days. Right? Maybe you could find, 2.5% online, but there's no high yield savings accounts anymore. Maybe another 10 years, 20 years from now, we'll get back to 5, 6, 7% savings accounts, but no time soon. So high yield could also refer to bonds. So you could have a bond that is what's called a high yield bond, which is another term for junk bond. So back to Tesla example with the bonds, those bonds are creeping right up there to high yield territory because there's risk that's associated with it. So there's a risk that Elon Musk is not going to pay you back if you lend him money. So in order to attract money, he needs to offer a higher yield, a higher interest rate, a higher rate of return on those bonds to get people to invest in them.
You should look into the bond market. That's where the money is.
Lens and junk bonds.
The next one, which we touched on a little bit earlier, is IPO, and that's an initial public offering. So you'll hear people say like, oh, my advisor was able to get me in on the Beyond Meat IPO a few months back, and my stock is now up 300% after the IPO. And all that means is the initial public offering. That's when the stock went public, when you were able to purchase it on the exchanges, when the company decided to go from being privately held to being publicly held and offering shares through the exchanges to the public. The next term you might hear get thrown around, and it's bull or bear. So you could hear somebody on TV saying, I'm very bullish on the market. And that means that they think that the market is strong and is going to continue going up. And the opposite is, I'm very bearish on the market. So when somebody says that, they're negative on the market. They think that it's going to be going down. And you have some people on TV where, they're perma bears, we call it, where they're always bearish. They're always negative. No matter what's going on in the world, they're always predicting doom and gloom and worst case scenarios, always saying this market's overvalued, that you should be in gold, you should be in cash. So you have some of those people, and then you have the people that are forever optimistic, where no matter what's going on in the universe, they're saying stocks are going higher, stocks are going higher. And it's amazing how you could turn on CNBC and have 6 of the smartest people in the world in a room, and all of them have a different opinion of where the stock market's going, what you should be doing next. That's why it's so important to, just not listen to the noise that's out there, because everybody has an opinion and not everybody could be right. So it's tough to actually take advice from people that you hear talking on TV, because nobody really knows. Next one is another term that you hear often, mostly coming out of the mouths of financial advisors and people who are giving you advice. And that's diversification, which basically means you shouldn't put all of your eggs in one basket. If you're going to invest in stocks, don't just buy Microsoft, right? It's better if you have a whole basket of stocks. If you have large stocks, small cap stocks, mid cap stocks, international stocks. You want to have a diversified portfolio of all different types of stocks, if that's the asset class that you choose. Then you could start putting together different asset classes as well. Maybe you're going to invest in bonds also. You don't want to just have long-term bonds. You want some short-term bonds, maybe some government bonds, some corporate bonds, some junk bonds. So all of this put together is diversification. This protects you where if Microsoft goes bankrupt, if you're very well diversified, it doesn't make a difference to you. But you could look at it at the other way as well. People who are not diversified, for example, Bill Gates, he wasn't very diversified, right? He put all of his money, all of his investments in one company, in Microsoft, or Mark Zuckerberg. People who find these companies, they're not diversified at all. They put all their eggs in one basket. So it depends on, if you're going to be a business owner, most business owners, all of their money, all of their resources go into their business. So that's a good way to get rich also. But that's why it's high risk to start your own business, because if the business fails and you end up, with nothing at the end of it, then you're out a lot of money. But just from an investment standpoint, when you're investing for retirement, the move is to be very well diversified. Try to just get the averages of the market. You want to be well balanced. And then the last term is hedge fund. So what a hedge fund is, it's very similar to like a mutual fund where you have somebody who's managing a pool of money and they're creating a portfolio. The big difference is with a hedge fund, they're able to bet or they're able to invest for markets going up and markets going down. So they have alternative investment options that are available to them where, for example, they could bet on stocks going down. They could bet against the economy. They could make money in an up market or in a down market. So in theory, that sounds great. Do they all do that? No, they don't. But that's the selling point with hedge funds, is that you're getting a very sophisticated individual that's behind the curtain that's able to trade in this hedge fund and make money no matter what is going on in the economy. So if you pick the right hedge fund and we have a tremendous downturn in the economy, you could make a lot of money if they were invested that way. So they have the opportunity, up market, down market, sideways market, no matter which way the market's going, they are managing that to make money for you in any of those markets. So this weekend, when you're at a barbecue, hanging out, throwing some beers back, and some random guy is talking to you about how bullish he is on the economy and how you should sell all of your bonds and screw diversification. The only thing you should be doing is buying high growth individual stocks and ETFs. Try to get the highest yield that you possibly can. Strike while the iron's hot. At least you'll have a clue of what the hell he's talking about. Hopefully this vocab session was helpful for you. I plan on doing more of these in the future, not just on investment terms, but on all different personal finance terms. Please hit that like button if you like this video. Just touch it down there. Just hit it for me. Hit that subscribe button as well and the little bell on there so you get notified anytime I upload a new video. Check out schoolofpersonalfinance.com. Join my email list. I usually send out maybe 1 or 2 emails a week with my latest blog posts or when I upload a new video. I appreciate so much you spending the time watching these videos. I will see you again soon. Thanks.